What's going on, guys? It's Jimmy here. So the Fed, the Federal Reserve, and the Federal Reserve President, Jerome Powell, just gave a speech, and it's very interesting. It has millions of people here really sitting on pins of needles. I'm going to give you guys the details. I'm going to let you hear directly from the Fed here, and it could lead to massive money printing and also will affect interest rates going forward. It's going to affect millions and millions of people's money and pocketbooks, and I'm going to let you hear directly from the Fed, and I'll also let you hear from the Labor Secretary here as well, as we have got some big information here for you guys in this video. So I'm going to give you all the details here right now as we're live right now here on the YouTube It's Jimmy Show. Let me know if you can see and hear me. Type yes in the chat. Let me know where you're tuning in from. You can let me know your city, state, or even your country, as we have people tuning in here from all around the globe. Don't forget to hit that like button for me here. And if you haven't yet, subscribe down below so you don't miss out on future videos. I will keep you up to date. All right, so take a listen here to a couple excerpts of what Fed Reserve President Jerome Powell had to say here. Take a listen.
There really isn't a risk-free path now, since it appears that inflation is certainly running above our target and appears to be continuing to increase quite gradually, but increase. It's still on the way up. So there's a risk there that would lend to greater persistence. But now the labor market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So, those two states of affairs for our two goal variables, call for different monetary policy responses. So, as they come more into balance, I think the idea has been that policy should move from being, tight to some degree to being more neutral as those two things balance out. But it is clear, though, that if we move too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. And if we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two things. I think for the last few months, we've been able to maintain a restrictive stance because the labor market was still pretty solid. I think that the data we got right after the July meeting showed that, which adjusted back all the way through May, showed that the labor market has actually softened pretty considerably and puts us in a situation where the two risks are closer to being in balance.
So I'll let you hear again from him here in a second, but Jerome Powell says there could be pain ahead. Inflation is rising more than they want. You guys can let me know your thoughts in the comment section. Are you seeing inflation? Let me know down below in the comment section. Are you seeing inflation at the grocery store? Are you seeing inflation at different prices? Let me know down below in the comment section, yes or no. And they're seeing job losses. They're seeing tremendous job losses. And the Fed is not sure what to do about this. This comes after they already just recently cut interest rates, which a lot of people were happy about. President Donald Trump actually wanted them to cut rates more. And, well, when they cut interest rates, it lowers your credit card interest rates, it lowers mortgage interest rates, it lowers refinancing interest rates, it lowers personal loan interest rates, car loan interest rates, lease interest rates, all these different interest rates, including the interest that the government is paying. And the government's paying about $1 trillion a year on interest alone. So a lot of people want lower interest rates. But as you can see, the Fed says that there's a lot of problems on the horizon. Take a listen to what he also says here.
Our long-stated plan is to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserves conditions. We may approach that point in coming months, and we are closely monitoring a wide range of indicators to inform this decision. Some signs have begun to emerge that liquidity conditions are gradually tightening, including a general firming of repo rates, along with more noticeable but temporary pressures on selected dates. The committee's plans lay out a deliberately cautious approach to avoid the kind of money market strains experienced in September 2019. Moreover, the tools of our implementation framework, including the standing repo facility and the discount window, will help contain funding pressures and keep the federal funds rate within our target range through this transition to lower reserve levels. Normalizing the size of our balance sheet does not mean going back to the balance sheet we had before the pandemic. In the longer run, the size of our balance sheet is determined by the public's demand for our liabilities rather than by our pandemic-related asset purchases. Non-reserve liabilities currently stand about $1.1 trillion higher than just prior to the pandemic, thus requiring that our securities holdings be equally higher. Demand for reserves has risen as well, in part reflecting the growth of the banking system and the overall economy. Regarding the composition of our securities portfolio, relative to the outstanding universe of Treasury securities, our portfolio is currently overweight longer-term securities and underweight shorter-term securities. The longer-run composition will be a topic of committee discussion. Transition to our desired composition will occur gradually and predictably, giving market participants time to adjust and minimizing the risk of market disruption. Consistent with our longstanding guidance, we aim for a portfolio consisting primarily of Treasury securities over the longer run.
Will this lead to the Fed lowering interest rates even more and perhaps money printing like they have in the past? This has also led President Donald Trump to propose and back the idea of a $2,000 tariff-funded stimulus check that President Donald Trump proposed. New stimulus checks from $1,000 to $2,000 per person funded by the money that's coming in from the tariffs. So technically, they wouldn't even have to print money for this specific check, which President Donald Trump approves of. Here is the U.S. Labor Secretary weighing in. Take a listen.
Well, let's talk about jobs because, the president is trying to use this as an opportunity to cut down the size of government. Are you expecting layoffs in your department, the Labor Department?
We have no expectation of any reduction in force, but there are people who work at the Department of Labor who are furloughed, who cannot get back to work. And a couple of those things that matter. Exactly the executive order that the president asked. He wants the accountability and the streamlining of the American taxpayers' dollars. He understands that absolutely we want our federal government to be reduced in size. We want the private sector to grow. And that's exactly what we've done under this president. Private sector jobs have been the focus. Under the Biden administration, everything was in the federal government and their growth. So do we want accountability? Yes. Do we want to hire people who work at the federal government to be aligned with the president? Absolutely. America First policies matter.
Let me ask you about that, because artificial intelligence is obviously creating lots of efficiencies across business. No doubt it will cause job cuts. I mean, look, I recognize that there will be new jobs created, just like the .com era brought us coders and engineers and all these other jobs that we didn't even know we needed. So that will be the case here as well. I'm not against new technology creating new opportunities, but what is the plan for those jobs that will no doubt go away because of AI efficiency?
Well, I think that's exactly right. We have to have a plan, and there is an AI action plan. That initiative, I sit on that task force. We have to make sure that we're offering our businesses the flexibility to understand that they can, research and development for new jobs. We know we're going to create new jobs, but AI is here to stay. What I'm doing at the Department of Labor is deploying Make America Skilled Again grants. $86 million just went out to 14 different states right before this shutdown.
And also, I wanted to show you something really groundbreaking in the crypto space. Take a look here. House of Doge, the corporate arm of Dogecoin Foundation, is going to list officially on the NASDAQ, which is groundbreaking, through a merger with Bragg House Holding, backed by over $50 million of investment capital and established access to additional capital sources. This Bragg House merger with House of Doge brings payments and tokenization, gaming, and yield to crypto's most loyal community. And this is going to be game-breaking now that they're on the NASDAQ under ticker symbol TBH. In fact, with House of Doge's partnership alongside some of the biggest name in crypto like Robinhood and 21 Shares, and backing from Citadel and Pantera, House of Doge is bringing Dogecoin into mainstream finance. And as you can see here, the strategic partnership announcement in kind with Dogecoin to become the first cryptocurrency accepted across It's 4,750 U.S. restaurants, bars, and cafes. As you can see here on Yahoo Finance, House of Doge, the corporate arm of Dogecoin Foundation, has gone public in its latest move by backers of the popular meme coin Dogecoin to infiltrate Wall Street and boost the token's adoption in traditional e-commerce, in my opinion, creating a huge opportunity now that it's on the NASDAQ. Also, there's some key leadership at House of Doge, like Marco Margiotta, who's the CEO and director, and has a proven record of building and scaling financial technology companies. Previously, he was a co-founder and CEO of Payfair, where he led the company from startup to IPO, reaching over 10 million users and facilitating billions in earned wage payments and ranking as the #1 financial app in the US. Payfair was later acquired by Fiserv, a Fortune 500 payments giant. The company will soon be trading on the NASDAQ thanks to a reverse takeover by Braghouse Holdings, ticker symbol TBH, a college-focused online gaming business. Prior to this morning's announcement, TBH has surged over 43% in the last 2 weeks. Also in partnership with Clean Core Solution, stock ticker Zone, Z-O-N-E, who is the official treasury of Dogecoin, their stock is up over 32% over the last 6 months as of the time of filming. And Clean Core, which is ticker symbol Zone, Z-O-N-E, has just acquired an additional 100 million Dogecoin, expanding digital asset treasury to over 600 million Doge. So as you can see, these two companies are really setting the pace. And they're continuing to build momentum towards achieving a target of 1 billion Doge held within 30 days. When you invest into House of Doge, ticker symbol TBH, or Clean Core Solutions, ticker symbol Zone, it's not just buying into Dogecoin, it's investing in the engine driving its next era. House of Doge, ticker symbol TBH, is actively managing and expanding the Dogecoin ecosystem through yield-producing products, institutional partnerships, and payment infrastructure that unlock Doge's real-world utility. When you buy TBH, you're investing in the corporate arm of the Dogecoin Foundation. As the Dogecoin ecosystem grows, so does the enterprise value of House of Doge. When you buy Zone, you're investing in the official Dogecoin treasury, the entity that holds, manages, and grows Doge, holding at scale. Zone captures the entire yield opportunity of Dogecoin by professionally accumulating and managing Doge through the structured treasury operations, transparent reporting, and institutional-grade custody with Bitstamp by Robinhood. So, in my opinion, there's a huge opportunity right here, so I suggest you check out both of these companies. But as always, do your own due diligence, and thank you to them for sponsoring this video. I will keep you up to date here with everything you need to know about here on a daily basis. So make sure to subscribe down below so you don't miss out on future videos, and share this video with anybody that needs to hear this information, and thanks for watching. Click here to see the Pentagon preparing for war. Thanks for watching, and I'll see you